Okay, we should be back online. The internet went down on me really quickly, which is probably no surprise after seeing how slow some of these scans were going, but hopefully it speeds up a little bit. It looks like we're dropping a lot of frames off the bat right here. Hopefully it stabilizes a little bit. All right, I think we are back in action. I am going to resume as we previously were. And if there's still any issues, please let me know in the chat. But again, you might not even have been able to let me know in the chat because you couldn't see it. So maybe the logic on that question was a little flawed. But, rolling back through with the SOL, we saw that this one had a pretty decent drop. Although, I'll tell you what, it was trading at 766 when they had earnings, went up to 932, and then dropped back down to 82. So while it had a pretty bad Friday, dropping 7.7%, when we take a look at this, we could actually see it was up decently on the week. So maybe let's back out to the 20-day chart here. Yeah, bottomed out. It looks like there's a decent base forming in this low $7 range. So let's take a look and see what these options are offering to us. So again, we know if we're able to sell these, first thing that really comes into mind here when I take a look at this is there were only 92 of these traded. And while, yeah, that's enough for you to potentially execute a trade, the issue might be that, hey, if you wanted to open a substantially sized trade, because these only are going for $30 a piece, it might be difficult to do with such low volume. So that might be one I try to stay away from. Let's see if my requirements help us out here a little bit. Normally it'd be $7,000. Looks like it only takes $1,500 of buying power on that one. So not too bad. You get 300 divided by 1,500. I think that's about a 20% return on capital that you invested in that place. So, not horrible if you wanted to take a flyer on about 10 of those and see if you could pull $300 together. And if it doesn't work, you've got a 870 basis. But again, I'd like to back further up and look at the bigger picture, and you'll see that this thing used to be trading at about 151 last September. So that really isn't that long ago. And while it has mellowed out a little bit in this range, which is why, it might not be the worst entry of all time, this is always something that would be lingering in the back of my head and kind of scare me a little bit. But with that said, one of those where as long as you're mindful of the fact that, hey, this is pretty risky based off of prior price action, as long as you're okay with that fact and accept that, not the worst thing in the world. I might throw that on my weekly watch list that I've been adding to the profit tracker, SOL8P, because I've only got one premium chasing play in there. It's never a terrible idea to mix in another one. So let's see what's going on here. Back to our scan really quickly. Doesn't look like anything else. AMC is one obviously that keeps showing up, and let's talk about AMC really quickly. So AMC has had this crazy run up again. As you can see, it peaked at 36.72, and this price action looks a lot like what happened back in, the end of January, early February of this year, when it ran from what it looks like $1.90 all the way up to 25 at the peak, and then fell back down to the $5 or $6 range. So I do definitely expect it to drop back down, but why is this significant? And the answer, of course, if we zoom in a little bit, is because of the option premium that a run up like this gives us. So this is crazy, and red alert here, because I will never ever recommend something like this, because this is legitimate gambling and so far outside the scope of what we try to do in the context of our strategy. But I feel like I'd be remiss if I didn't point this out, because we love to talk about option premium. So you'll notice, if we're only showing 14 strikes here, it goes up to 32. But at 32, you'll notice there's a decent amount of premium, $500-600 of premium per call that you sell. We do know naked calls, when you sell them, have unlimited risk. So definitely, unless you know exactly what you're doing, be careful with this. But why I'm pointing this out, because this is something I did, and why And I will say it's something I'm not including in my profit tracker because it is not within the scope of our strategy. But there are strikes all the way up to $70. And you could keep scrolling, and you'll see these go for about $2.30. And that is a June 18th strike, June 18th expiry, 70 strike call for roughly $2.40. So every one of these you sell, you'll be able to get $240. An example, if you sold 10 of these and wanted to get $2,000, it only takes $2,500 in collateral, which is, almost a 100% return on capital. And 1000% the recommendation here is not to use all of your buying power on this, because if this actually does squeeze up past 70, you are probably going to lose more than what you have in your account. So if you do something like this, make it a very, 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 very small play. But it's one of those things where anytime there's a relatively high percentage play where you can make 80% return on the capital that you have invested, I feel like I've got to point it out. So I did that exact play. I sold 10 of these. We've got $2,500 locked up in it, and we're going to hope that we could pull, a couple grand off it. And again, that's as long as it stays below 70 in the next 3 weeks, we have to zoom out to here. It would need to get up here. And how high up is this on the y-axis? Well, when we're this far zoomed out, it goes down to -30. So 0 is really right here. I don't know why the axis started negative. That's what they had to do to, squeeze 70 in there. But point being, really high percentage play. Super risky though, so be very, very, very careful. Be sure you have, a mental stop limit where you say, hey, if it reaches this price, I just got to get out. That's just the way it is. One quick thing that we could take a look at potentially. I don't know if I could plot it from here. I don't really want to. Let's see. Yeah, so great comment from Dashio in the Twitch chat is the market cap for AMC would be at least 30 billion if it traded above $70 a share, which is absolutely nuts. And I think right now with where AMC is, it's actually at a comparable valuation or market cap as GameStop. So we know GameStop is at, 220 plus. Let me check this really quickly. If we go AMC market, I guess the easiest way to do this, AMC stock, you'll take a look down here. Their market cap is $11.76 billion. GameStop is 15.7, right? So I think when AMC was back in the 30s, it was about the same. But an $11.7 billion market cap as compared to a $15.7 billion market cap. So if AMC was the same as GameStop, it'd be about $32, $33 a share. And we know, GameStop is pretty wildly overvalued right now. So anytime someone tries to use the rationalization that, hey, AMC could go up to 200 because that's exactly what GameStop did, you could take a step back and realize, look, stock price is not equivalent to stock valuation. An equivalent stock price for AMC to get up to that 200 that GameStop is at is 32, 33 bucks a share. And I can tell you the exact number here, right? So we know GameStop is 15. We're going to call it 15 billion. So it is 15 divided by 11.76. So it's 27% higher. Multiply that by the stock price of $26.12. So AMC at $33.31 is the equivalent of GameStop at $220. So there's so much stuff I see on social media about this because I love to read up on it. I think it's so fascinating how these stocks have moved. And obviously, I love to be someone who could potentially take advantage of the pullback in the form of collecting option premium. So I've been reading up all these different investing theories. People saying, oh, AMC is going to run up this far. But, the only math you need to be worried about right now is the math that we just did on the screen, showing you that at $33 a share, AMC is equivalent to this price level for GameStop. And I think that, disproves about 50, 60, maybe even 70% of the AMC investing squeeze theories out there. If you want any more, information to help you feel a little bit more comfortable in this, GameStop squeezed because there was a pretty large lack of available shares to trade. AMC diluted their shares, and there's a lower short interest than what there was back in January off their initial squeeze. So I've got to be thinking a lot of big players were loading up on the way up here for AMC. And let me flip over to AMC. I think a lot of big players were loading up, and then, eventually the rug is going to be pulled out. I expect at some point in the next 3-4 weeks that we settle back in this $12 to $15 range. And while, if you're bullish on AMC, I hate to be the guy, that's going against the super exciting, investing party that everyone's been having with AMC and GameStop. But at some point, you've got to put a little bit of thought behind the trade and understand that, taking your chips off the table at 25 is probably a pretty damn good idea if you have a bullish position on this one. But with that in mind, I'm going to keep selling these until the premium goes away, because in my mind, that's, not free money, because there's no such thing as free money. You never know what could happen to what could happen tomorrow in the market. But I think this is pretty high percentage in terms of what we're doing. So that is my little discussion on AMC since it popped up in the scan. It was something that I opened a position on last week, even though you won't see it in the profit tracker for the reasons that I've already mentioned. But with that in mind, we still haven't talked too much about what we could do for the upcoming week here, right? We've got maybe SOL 8 strike puts, but that one is another stock that is pretty risky. I want to try to get into some of these that I could, safely highlight green and say these are safer plays, more stable stocks, great entry points. And funny enough, I think Apple is getting close to a good entry again. Now it's been pulling back a little bit in the face of the S&P 500 continuing to rip upwards, but I think there's really great support for 120. And anytime I would find an opportunity to, sell a put in that 110 to 115 range and get some premium for it, I think that's a really great opportunity. So let's take a look at that range. We could go back to the top here. We know, weekly puts probably aren't going to provide the best premium in that range. You've only got 0.14% return on capital risk, which is, I'm sure, even less not even less, but incredibly small as well if you look at it in a return on capital standpoint. Yeah, less than 1% return on capital. For you to get any sort of meaningful return on Apple from an ROC perspective, you probably need to go to this 122, 123 range, which, not terrible, but at the same time, if the market takes a pretty big dip, as we saw like here, we saw maybe here, we saw here, a $10 downward move in Apple is not out of the question, and that's not something I'd want to be loaded up on at 122 and 123 and have to bear the brunt of that. So important to stay patient, wait for the opportunity when it comes, because I guarantee you the market isn't going to go up every single day for the rest of our lives. And I feel like there's always at least one time a month when I wished I had more buying power, because things are moving against me. I see some great entry points, but instead of having capital on the sideline ready to deploy and enter into these new positions, I'm too busy managing my current positions and trying my best to avoid a margin call. So as we've mentioned on previous streams, that's something where I've tried to get a little bit better. I think the position I have entering into this next week, and the position I was in last week, put me in a great spot for that. I'm really happy with how I've handled that. But now comes the hardest part, which is the patience. In a literal sense, it's the easiest part, because you don't have to do a single thing at all. But sometimes you sit behind that screen. There's so much going on. There's so many people trading that you get a little bit of fear of missing out, and that part just makes you human and what makes trading so tough. But we're gonna hold off as much as we can. Maybe we could look out to June. 4.82% with the 119 break-even price. That break-even price is right around here, just below an area of support that goes back to early March. So that that's not too bad for a 3-week play if you're trying to pull a conservative 4 or 5% moving forward. That's something where if you wanted to dump, let's see, it looks like, yeah, if you wanted to dump 20 grand, you can make 1 grand, but the question is whether or not you want to have that money tied up for that long in that kind of a play. So we're going to leave that one alone for now. Some of you guys will remember we sold actually 110 strike puts on Apple off of one of these drops, and it worked really nicely. The issue right now is VIX, the volatility index, is pretty low, so put premiums on stocks are also pretty low. So if we can get a little bit of a spike in VIX, a little bit of a spike in put premiums, we can maybe take advantage of some of these larger, more stable stocks, selling a couple weeks to expiry deep out of the money in what should be a really nice high percentage play with a great entry and pretty nice return, all things considered. So we're going to keep our eyes peeled from that. Apple, probably going to stay away from. AMD is one we like to sell puts on, but it's already up back past 80, and that's a little bit higher than I think I'd be comfortable with. Let's go back to Zillow. That's one we like to play a lot. Again, this is the 180-day chart, so you've got a lot of context about how this play has been going lately. 120 might be a decent level of resistance. I think it looks like 126, 127 might be a little bit stronger, so I could see it going up there. Let's take a look at what we could get from a weekly put perspective. This is a lot more promising. You could go all the way down to 111 and get a 4.58% weekly return on capital. And as we know, next week, important to keep in mind, it's just a 4-day investing week. So all of these percent returns, return on risk, return on capital that we're looking at, they apply to a 4-day period instead of a 5-day period. So, maybe 20% more impressive. Not that that's a huge deal there, but always something to keep in the back of your mind. And really not a bad deal from an ROC perspective. I think what I might do is very similar to what we did last week. Maybe sell a few of these at this price point. If it keeps running away from us, we'll bag a couple $100. But if it drops back down, we're going to have a great entry point into a larger position at a more favorable strike. So I think that's definitely something I'm going to look to do tomorrow morning. So we're going to take a look at, we're going to throw Zillow on the list as far as what strike we want. Maybe zoom in a tad. Really nice support at 105, which is why ideally, I would have loved for it to pull back to this 105 level last week, so I could have sold something even further out of the money. We didn't get that. It looks like, 112, because we see some peaks at 112. We see it bounce off 112, bounce off 112. 112 looks to be a pretty decent price point. I think that might be where I start to initiate a position on tomorrow, Tuesday morning. If we go right at the midpoint here for $1, it looks like we could put up, see, that's still a decent amount of cash, right? I might put up 10 grand to make 500. So I don't hate that idea. But in general, I really want to wait, especially on these plays where we can use leverage to make, small RORs and turn them into big ROCs. That is when I think leverage is useful and, isn't going to be the most effective when the stock is trading a little bit flat over the last few days. Usually when we see a big downward move like what we saw at the beginning of May, that's when the premiums start to look really attractive and you can get some really good week-to-week returns. But, I will initiate a small 112 put position tomorrow morning on Zillow. So I'm going to throw that on the watch list. Another one that we like to go back to is, I was going to say Etsy, but I think that one's also running away from us a little bit. 164. It's not gone yet. I think this definitely indicates we've got a decently strong base in this mid 150s, low 160s. And great question in the Twitch chat. We've got, what about a smaller account starting out? What about, BBBY and Nikola? And that's an awesome question. We try our best to, tailor our plays to accounts of all different sizes. I'm sure some of you guys are tuning out when we have our discussion about Apple or Zillow because those things are trading over $100 a share. Not everyone has 10 grand to sink into a trade. That is perfectly okay. LOTZ is one that we opened that had a lower price point for entry, but to the point of JWP 806 in our Twitch chat. Had a hiccup there like a little toddler, but we're back. BBBY is one that's a little bit lower. Let's pop it into the chart and go through our normal process here. Again, first thing that we notice, it's going to have good premium because it ran from 23 up to 30 at the peak last Friday. So if we pop over here, we know the ROR. Let's drop it down to 13 here, get this out of here. We know ROR right around the money is going to be pretty damn good, right? And these ROCs are even better. That's some phenomenal returns on a week-over-week basis. I mean, if you can get 10% on this, let's see if the math actually holds up here, right? It's a little off because they're not going to give you full margin privileges. But, if you wanted to sell at 26 and get 1.38%, that's not too bad. If we look over the last month, the decent base around 23. But what really scares me about BBBY is if we go, actually, I hadn't looked at this one in a minute, so I remember a lot more of it back a year ago, if we back out even further, but when it was trading below $10 than I do, when it's trading at the mid-20s. And I will say, based off this chart and the price action that we've seen lately here, this doesn't look to be too bad. Obviously, you would like a little bit of a better entry because it just jumped up $4 on you. But even if it started to drop on you, I think if we took a look at the more recent price movement, which is what we started with when we had this chart pulled up, I think there'd be something to catch you there right around that 24, 25 area. So not the worst place to get started selling. However, if you're selling these fully cash secured, which is what I definitely recommend if you're starting out, you're really only pulling 1 or 2%. I think this is another one where RSI is a little bit elevated. We love the indicator because when it goes into the red, as you can see, it got red here, it immediately dropped back down. Ran back up, got into the red again, immediately dropped back down. But it is, while not in the red, a little bit above 50. So, slightly overbought, but maybe not severely overbought. So maybe if BBB1 is one that you like, I'd say let it rip. Now, I will say Nikola is the other one that we wanted to talk about or was suggested. This one has a lot of premium because it's up 50% from the price. It dropped to $9.91 back on May 6th earlier this month. And that's just natural when something runs up that much in that short of a time frame. The issue I have with this one is that, the premium's good, but you have to take a look at it in the sense of, when we enter into an HT wheel type play, we want to do it on a company that we're comfortable holding at a price that we're comfortable holding at. Now, if you look at Nikola, back it up to a year, you might say, okay, awesome. Yeah, I'd be totally happy holding something like this at 12, 13 bucks a share because it used to be up near 100. From that perspective, you've got half the equation. You've got a stock with a price that you'd be happy holding it at. But the second half of that equation is, would you be happy holding the company? And to me, this company is just kind of full of hot air. I don't think they actually have anything that is legitimately of substance that would lead to them being a successful company. So, in my mind, they're kind of on a one-way path to zero. This isn't the type of company that I'd feel comfortable holding on to as a long-term investment in the event that I was assigned. So I would personally stay away from that one. But if it is, again, one that you wanted to get on, that ROR looks really, really, really good from a weekly perspective. But, that put premium is there for a reason because, there's a pretty heavy bias on the downside on this stock. Now I see PLBY being thrown around in the chat, FCX. Let's take a look at both of those really quickly. And then after that, we're going to get into earnings, and then we're going to take a look at call skew. And I think that should wrap up what we're trying to accomplish for tonight. So PLBY, yeah, typical SPAC chart, right? It was trading at about 10, popped up to 60, dropped back down to 45 cents. And you know what I want to talk about when I see a chart that looks like this is my close favorite stock, Hyliion. So let's see what happened here, right? The price action right here, it's trading at 10, bumps up to 58, back down to 45. This looks almost identical to Hyliion through the end of September. Let's go back to PLBY. You see these two charts? They look the exact same. But what we know what happened to Hyliion, overvalued SPAC, came all the way back down below the net asset value of the original SPAC. So Playboy, I really think we have a very similar setup here. I think we're going to see this thing pull back down to 10. It might take a while, but definitely not one that I'd be happy with opening a bullish long position on. Almost one that I'd be happy, selling a 50 strike call on. Although that takes quite a bit of buying power. Maybe something further out of the money like 80. That's a little bit better right there. I like that idea a lot. So what I've been doing sometimes, if I do sell naked calls, is one thing I don't want to do is sell like something that expires in a week, right? Because if something moves against you in a week, there's not a lot you could do to manage it. Now, if we sell something like this, that's expiring 6 months out, all we have to do is pretty much have the IV on Playboy drop or the price drop, and the premium on this 80 strike call is basically going to get cut in half. And we know that what we could get from a return perspective is over 100% based on the capital that it requires. So if it drops by 50%, and you could buy these back for $2, $3, $4 per contract, you're going to be in a really nice position from a return on capital perspective. And if we see a sharp drop in the near future, you could realistically see a 50, 60% return on capital if the price of these gets cut in half over the next month. And that is a really, really solid value proposition. Another great follow-up question from JWP is, where to go? Do we recommend a certain account percent per position, especially for $10,000 accounts, so you don't risk blowing it out? That is also a great question because position sizing is such a big part of the strategy that we have. And with $10,000, I think it really depends, right? Because if you had something like Apple where you had $5,000 of collateral tied up in a position, right? And that's something that you can do, to be clear, because, if you wanted to sell this fully cash secured at, let's say 120, that would take $12,000. But if you wanted to sell just one of these and you had a margin account, you could do so for $2,000, right? So if you had a play like this on Apple where you sold a 120 strike put and it only took $2,000, you might say, okay, shoot, this takes 20% of my buying power. But you got to think about it in the context of, look, it's decently far to the money. It's a company like Apple. That's something where I'd be comfortable putting a decent chunk of it in. Now, if you're chasing something like LOTZ and you're trying to sell like a 5-strike put for June, and you wanted to sell, I don't know, 5 of those and get $400, but it's, oh wow, that does not take a lot of buying power. But point being, if you're in something more volatile like this, and you were looking at a play that potentially took 20 or 30% of your buying power, I'd be a lot more hesitant. I think personally, if I were at that $10,000 level, I would be looking to use things like spreads to maximize the amount of leverage I have with my capital, and not go all out in leverage, but I think there's some points in some situations where it's appropriate. But at the same time, maybe no position more than 30-40%. I think it's okay when you have $10,000 to have $4,000 of buying power tied up in an Apple put, because look, Apple's a steady stock, and if it gets assigned, it's not one of those things where it's going to shit the bed and go to zero and you have no recourse like this stock, which did this to us so famously. Like, you'll have a chance, for example, with Apple, if you have it drop, it's probably going to come back up. If it drops, it's probably going to come back up, and you'll have a chance to save the position. But if you are in a riskier stock and you've got 40, 50, 60+% of your buying power in it, and something like this happens, I mean, you are in some very hot water, and you're probably going to be locked into a pretty big loss. So riskier plays, I guess, to maybe summarize the thoughts that I've been throwing forward here. Riskier plays, 10 to 15%, I think is perfectly fine. Even 20% if you've got a pretty big conviction on something. But, if you've got a more stable stock, nothing wrong with throwing 30, 40, 50% at it if you're going to sit back and let it ride. All just, play to play, stock to stock basis, depending on how you feel about the safety of certain stocks, whether you understand you're chasing premium on something or whether you view a put sale as a really great entry point on a value investment going forward. So one of those things where I don't think there's a one-size-fits-all answer, but on a case-to-case basis, that's kind of the criteria that you should look at when evaluating different position sizes for your portfolio. And again, position sizing is one of the biggest points of the HT Wheel strategy we have, regardless of what stocks you're going into. I think you should never put 100% of the capital that you intend to use in the play in it up front. So if you did intend to throw 50% of your buying power into Apple puts, only put 25% in up front, sit back and wait. If you never need to use the other 25%, guess what? That's a great problem to run into, because you just hit max profit, and you could do it over and over and over again until there is the need for you to deploy that additional 25% of capital. So always scale into things like this. One more request from Morpho before we get into the other stocks on here. HITID. They're going on NASDAQ tomorrow. Let's take a look at this. I guess that means it's over the counter right now. HITID. High Tide. Morpho. My man, what is this? These are some wild candles here. Let's see if we could back up a little bit further. 20-day. Looks like this thing started trading. When did it start trading? Yeah, May 13th. So yeah, any other maybe supplemental info on this one you've got would be interesting. But again, what do we do when we don't know what a stock is? HITID. We go to analyze. Nothing comes up on analyze. Looks like we're suggesting that it's a weed stock. Not the worst idea in the world. They are making a comeback. The only thing I will say is HITIT. Interesting. HIT, see if anything comes up for that. All right, HITID it is. But, you know, obviously one of these things where entry-wise, probably not the best in the world. We love to use RSI as an indicator about when we should enter plays. It's up in the red, 72. And that probably is a function, as Morpho is mentioning in the chat, of, you know, ticker change. It's going to be HITI tomorrow as it's added to NASDAQ, which presumably would give it a little bit bigger of an audience for to purchase it. But with that in mind, maybe would have loved it at 7.5. It's, you know, tough justifying a short-term 10 or 20% increase in the price that you're going to buy a stock at. RSI is elevated. Last time RSI was elevated was up here, and it dropped down to, you know, this 830 level. So I'd say maybe wait for another drop down based off the RSI that we have right here. If it's something that you are super, super, super like convicted about, I mean, by all means, go for it. We don't need to have the same exact view on stocks. We're all here to look at things together, try to learn together and get some stuff figured out. And we could also take a look at SNDL more for just for you. But, you know, one of these things where I always like to enter plays with options, because not only can they help give you a favorable entry, but like when you get on the other side of the H2O and start selling calls and keep lowering that basis time after time after time, you know, it gives you recourse, it gives you a little bit of a cushion to trade with and keep in case things start going south on you. Stocks that don't have those options don't give you a similar luxury, and quite frankly, you know, they're a little bit scary for me. But, I mean, one of those things, you have to accept the fact that something like this, it's a weed stock. It went from $9 down to $7, back up to $9 basically in the span of, what day is this right here? This is May 18th. So in the span of 2 weeks, it made this kind of a move. So as long as you accept the fact that, hey, you know, this is a little bit of gambling, you know, why not? It's always fun to have a maybe high risk, high reward play where you could wake up the next morning with a 100% return on it. So not the worst thing in the world. And side note that I just remembered in the back of my mind, I do take a look at selling those Playboy ADCs tomorrow as well, if I can get a decent return on capital on those. So flip back, we wanted to take a look at SNDL before we pop into the other analysis we're going to run on this stream. Was trading at 70 cents, popped up on Friday above a buck. Looks like it's settled below a buck, but we know this thing's got a weekly option. There's probably some really nice premium that we'd be looking at. Absolutely. I mean, 97-cent stock where you could get 10 cents of premium, meaning your break-even price is at 87 cents, but, you know, your potential return is a 13-cent return on what would be an 86-cent basis, which I could do the actual math on that one for you if my calculator loads. Here we go. So a 13% return on something you would have an 86-cent basis on is a 15% return in a week, and that's just if it goes up above $1 in the next week. So really, really not a bad potential return here. One other thing you might want to consider is, you know, if you sell this call, your break-even price is going to be 97 cents minus the 11 cents to put you down to 86. And it looks like, you know, this is the exact same on the put side. So we were checking really quickly to see if there was call skew, to see if one option was potentially better than the other, but it looks like they are dead even as far as the premiums that they're offering. So it will give you an 86-cent break-even price, which is here. And, you know, if we zoom out a little bit, as we'd like to do so much, maybe that's not even useful because of the spike to 5 makes this chart look absolutely ridiculous. But an 86-cent basis is a little bit scary when you have a stock that was trading at 65 cents, below 70, just as low or just as recently as a couple weeks. One other study we like to look at to say, hey, can we expect this kind of RSI to be here in the future is the implied volatility study. So we're going to pull that up really quickly. And if I had to guess, it is going to be up a lot lately. And for whatever reason, I can't remember what order I comes in the alphabet, so bear with me there. And as I can't speak either. As you can see, it's run up a ton, right? It leveled out a bit here. I mean, this also does a great job of illustrating how quickly implied volatility can drop, right? You had it trading at about the implied volatility at about 2.1 right here, and it traded flat for a day and a half, or even just a day. And it dropped all the way down to 1.5. Now, it did spike back up and get the IV all the way back up to 2.28, which is about as high as it's been in the last 20 days. We could pop back up to 180. This is really back when IV peaked in early December. But we're not quite obviously at these levels we had in February when it ran up to $5 a share. But still decent implied volatility. The only fear rather is that it drops back down to these levels and you're stuck with an 86-cent basis on a stock where you can't really continue to sell covered calls week after week after week. So that's always something to keep in mind. Hey, high risk, high reward play. Hell, go for the 1.5 strike calls. Get you a 93-cent basis and try to get a 50-60% return. I know J Mart's always helpful in the chat, pointing out that the Senate has a legislation bill coming to the floor soon, and that should add to volatility. So that's always something to keep in mind. Again, definitely not something I would be highlighting green on my profit tracker, saying this is a super safe play that I'm happy with. But always fun to have something like this going, and I think the premium that the options provide us with give us a relatively safe way to enter into what would be a riskier play. So always a fun one to look at. So what I wanted to look at now was upcoming earnings for the week, because as we talked earlier, there are a lot of different strategies between iron condors, between naked stranglers, or even just, deep out of the money cash secured puts that we could use to leverage this extra option premium. And happy Memorial Weekend and good evening to you, Tommy Lee, which I'm again hoping that your name is pronounced like that, since I think that's what it looks like backwards. But I appreciate you checking back into the chat. Thanks to everyone who's been joining us tonight. So I'm gonna take a sip of water and I'm gonna pull up the upcoming earnings for this calendar week. So give me 1 second to do all that. And shout out to Creo V1 for throwing the follow at us while I was taking my sip of water. Maybe I should do that more often if that's what the people want. All right, give me 1 second. All right, clicking over. I think the easiest way for me to get this is just popping over into our Discord chat, and would be a great, segue to talk about our Discord chat if you guys are not members of it, because while it does look like a gray box on the screen right now, there we go, it loads. A bunch of people in here who are super, super helpful. We post all of their trades in here. It's tough to update everyone on all trades at all time on social media, but they all come into our Discord server here. So if you follow that, you'll be able to see every single trade that we make as we make it. Getting back to the topic at hand, which is earnings plays, we've got our own channel for that. But what we were looking for here off the bat is anticipated earnings releases for the upcoming week in the market. So as we can see, not a lot of crazy, attractive companies that we could enter in on here. Digital Turbine, APPS, we'll take a look at that because we initially were going to have a play set up on that. So let's flip back over to Thinkorswim, take a look at APPS. And it has since run up to 66 from the $60 entry that we had. And as you can see, this red dot here indicated when earnings previously were scheduled. So this is when we anticipated that we were going to have a little bit of volatility in the stock, but it never came true. And after they announced they weren't going to have earnings, as you can see, implied volatility kind of ran off a cliff there a little bit. So let's back up to the 180-day chart, see where potential points of resistance and support might be. And when we did our initial analysis, and when we talked about this, I think on the stream last weekend, J-Mart's pointed out we got 15 viewers. That's getting close to webcam time. Hey, it might be. I would be so happy if we had enough viewers on here for me to justify getting a webcam. And for whatever reason, the little tool that I have on my side that shows the viewers that we've got, it isn't working. So I have no idea how many I have at any given time tonight. So we're gonna keep it moving though. But we've got this red line that we drew here from last week, which showed what should be decent support at roughly, what's it drawn at, 52.90. So we told ourselves, hey, if we could sell a put at 52, $53 or below, we were gonna be happy with that kind of value. And as you could see, you could go pretty far out of the money on this thing and still get some really decent returns, right? Even the 53 strike puts are selling for about 50 cents of premium. You could get a buck 50 going up to 60, which is a little bit, cutting it close. That would give you cushion on a 10-cent drop. But the idea here is you could use a little bit of that buying power to set up, a $1,500 return on $6,700 of premium, which is maybe 23%. I'm not sure if that actually did it right. $1,500 on, what we say, $6,700 of premium. Yeah, 22.3% return on your capital in just 1 week. But, we are a little bit more conservative if we were going to do something like this. So a 53 strike put would be a little bit more our speed, where you could get a 10% return on capital, right? For if you wanted to do 10 of these, you'd make $450. You'd tie up $5,300 of capital. That honestly is not too bad of a value proposition right there. I don't hate that one either. So since we couldn't really get ourselves a great safe entry on a longer term HT wheel play, maybe the APPS 53 strike put is a good way to, have our money deployed in the meantime. So, we went to the well once last week to get us a little bit of money. Let's try to go back and see if we can't get a little bit more. Would also give us some excitement Tuesday afternoon for when they have their earnings announcement, and hopefully we could start the week 1 for 1 and get it going. But not a bad idea there. Let's pop back to the chat really quickly where we had this. And the other thing, Tuesday after close, obviously a little bit more recognizable of a name there, is going to be Zoom. So let's take a look at Zoom. $331. That is way higher than what I would ever be comfortable owning that stock at. If we back up to a year, pre-pandemic, right? We definitely want to keep that in mind. It was trading around 104. Now, one of the reasons I wasn't the biggest fan of Zoom is because I thought, hey, eventually the pandemic is going to be over. People are going to go back into the office. Zoom is going to be, probably about as irrelevant as it previously was. But as we've seen, there's been a pretty big shift. And again, I'm kind of going on this little spiel here because I think it's really important to analyze macroeconomic trends as you're making potential investments within, those individual sectors, such as the remote work sector, I guess you could call it. But, I was, for the longest time, especially when it ran up here, I was like, look, I don't think this thing has any business staying up this high. I think it's going to go back down to this range once the pandemic is over. But as I was kind of starting to say, we've seen a pretty big shift in how, people have been working. A lot of people have adapted either full-time remote or hybrid roles where they're half working from home, half working from the office. But either way, both of those options would necessitate the type of offerings that Zoom has. So I think there definitely is a case for it to maybe not stay this high up, because I think this is still a wild valuation on a forward PE basis. But, definitely I don't think it's in danger of falling back to like 100 or below anytime soon. But with that said, I think the numbers coming out as people begin this workplace shift, if Zoom could report strong numbers, we see some pretty significant upside. But at the same time, if they're reporting, hey, people are going back into the office, we're going to have to kill our guidance going forward because our services are being rendered relatively useless. Or maybe if Microsoft Teams even is taking a bigger share of that market, they could be in trouble. So for me, those two potential outcomes for their upcoming earnings make this one a little bit too volatile with me. But hey, if that's something a risk that you're comfortable taking on, why not? Let's take a look at it. So the great part again about these options, and shout out to Bennett Spencer for subscribing. I love hearing that notification noise lighted up on the screen. But if you wanted to be relatively conservative and sell a cash secured put, right, we could say, hey, maybe 300 is going to be decent support. If you want to get super safe, I think 250 is going to be very, very safe support. Is there even any option premium at 250? Funny enough, there's actually a tiny bit, which would be a hilariously large drop for Zoom if that came to be. But I think 300 is more of a more conservative place. And one thing that we like to do as well on the Analyze tab, flip over to earnings, take a look at Zoom. They seem to react pretty strong to earnings, right? They went from 79, to 94. They went from about 93 to 80, 69 to 62, relatively flat Q4 2020. Relatively went from 160 to 210 during earnings week, And then 325 to 457, 478 to 400, which is a huge $70 drop. 400 down to 330, and they've already run from 321 to 331 in the upcoming I guess in the week leading up to their upcoming earnings. So that type of volatility quite honestly scares the hell out of me and would, in my mind, disqualify this stock from any of the typical option selling plays that we like to go for. But again, if you like Zoom and wanted to get in at a $300 price, you could withstand a 10% drop at this 300 strike. You'd have a ton of money locked up. Good Lord, that is so much money locked up. 133 grand. Looks like they have tightened the old margin requirements on this one. But yeah, this is one that I'm going to be staying away from based off the setup. So popping back over here, Advanced Auto Parts, none of these are any that typically have a ton of option premium on them. We've got SPLK, I want to say, is Splunk's ticker. We could take a peek at that one really quickly. I think that might be interesting. There we go, SPLK. And this is almost the quintessential setup that we like to look at. Now, this is the 3-year chart. So, keep that in mind as we look at this. But we look like we have support maybe at 110 because it bounced off there June of 2019, September 2019, October 2019. It got below there, but bounced up pretty quickly back during the COVID drop. And more recently, at the beginning of May, it bounced off this same level. So 110 seems to be a pretty damn safe level on this one. And again, that would protect you from about a 10% drop if we pop over to, or even just look at their earnings here. That's not a very promising candle going from 200 to 160. But one of those things where, especially when you see this kind of downward movement leading into earnings, it begs the question, how much further down can it really go? So that's something we'll have to take into consideration. The 100 strike put looks like 2.9%. But again, 110 was the point of support that we identified. And you could get, 9.36% return on capital risked. Stick you with the 109 basis, which maybe wouldn't be the worst thing in the world. To be quite honest, I'm not even entirely sure what this company does. So again, we'll pop over to fundamentals. Oops, I gotta tap it in again. Their information technology, software solutions, collect, index, search, explore, monitor, and analyze data. So just another one of those software data companies that's off a huge drop. And honestly, going from 40 to 200 down to 120 reminds me a little bit of Zillow going from 20 to 117. So, in general, the entry point is pretty damn solid because this thing topped out at, 225. Let's pop RSI back up on the screen really quickly right here. All studies. I'm a little more familiar with where R is in the alphabet, so we can get this one up quicker. And yeah, we love RSI as an indicator for when to buy. And this thing is pretty much bottoming out on the 3-year. Let's take a look at the 1-year. Again, okay, it's back up a little bit to neither overbought nor oversold. But, with that in mind, the 3-year low RSI, we go into the 20-day, relatively flat. But again, we can see when it bottomed out at 110, it shot back up really quickly. These things expire Friday, so we've got 4 days that you have to survive. They announced earnings, let's see, Wednesday night. So, we could potentially, if we did open that APPS play and it went well in Digital Turbine, roll those profits into SPLK, and then roll into something on Thursday afternoon and maybe go 3 for 3 to have a perfect earnings week. And I think, honestly, since I don't have a ton of capital tied up in other longer term plays, that might be something that I try to do. Another play that we like to do is this Iron Condor or Naked Strangle, meaning not only do we sell a cash secured put or a put spread, we also sell a call or a call spread. And that is when you're trying to keep the stock between two prices as opposed to trying to keep it above one price or below one price. Usually when we see a setup like this, if something falls this far, this quickly, and has a peak of 222 within the last 180 days, there's a little bit too much upside risk for me there to sell the strangle. So I'm probably going to stay away from that type of a play. If I do anything on this one, I said do right there. But if I do, open anything on this one. That might be the more mature way to word that. I think 110 put is going to be where I'm looking, so I'll throw that one SPLK. 110p. Earnings Tuesday after market. Earnings learned how to spell. Wednesday after market. And that leaves us with one more company that is reporting after market on Thursday, which I wanted to take a look at, and that is DocuSign. So another one of those companies that saw a pretty big run up during the pandemic just due to the necessity of the business offering that they had. So they're up at 275, right? If we take a look at this is the 180-day chart, right? So 275 back in February, and they've dropped all the way down to 200. So really good entry. And as indicated by RSI, I mean, I think I'm at the point where maybe I just need to get alerts when RSI drops below a certain number, because the second it went blue, it bumped right back up to almost 200 a share. So these again, this is why we love RSI. We love it so much. We got another question in the chat really quickly. Brief tangent about why we decide to do a covered strangle on a position, or when we would decide to do that. So in a literal sense, a covered strangle is when we have 100 shares of the stock, we've sold a covered call, and then we've sold a cash secured put. I typically don't like to do things like that for earnings just due to the volatility. But when we actually do that is as a part of our HT Wheel strategy, right? So we know that from the jump, we'll sell a cash secured put. If we get assigned on it because the stock drops, we'll have it at a favorable basis. But what do you do from there? Do you keep adding? You're going to be selling cash secured puts to drop it even further. But what could you do besides that to further decrease your basis? And the answer is a covered strangle. And that's actually something that we had open with UWMC, right? You'll see we have a strangle in the sense that we have 8 strike puts and 8 strike calls. Well, this is actually technically a straddle because they're the same strike, but similar idea where we sold calls, we sold puts, and the calls are covered by shares. That would be a covered strangle. We don't typically try to do that with earnings plays, just again due to that volatility. And I like to be able to get in and out of things really quickly. And I think avoiding the covered aspect of that helps accomplish that. But if you wanted to cap your potential max loss using something like an iron condor, that's also like an equally valid strategy. But getting back to what we were talking about with DocuSign here, let's see where we could start to get some premiums on here. It looks like 190 is about the level where you could start to get some respectable money on there. And that looks like a really, really, really good, point of support over the last 180 days. It's bounced off 190 multiple times. 190 would be a 5% drop from here, which is honestly not a ton headed into earnings, but I was about to say it's not the most volatile stock in the world, but as you can see, it is pretty damn volatile. But right here at this 190 level, it looks like you'd be able to get about a 10%, just under a 10% return. Yeah, the ROC is correct there, 9.44% return. Not the worst value prop in the world. Might be something if we try to do a little 3-day earnings run right here. Oops, let me get back down to my current list. If we try to do this little 3-day earnings run, that'll be what we clean it up with on the back end. Docu 190p, Docu 190p earnings Thursday after market. So I think that is probably a pretty good 1, 2, 3 punch that I'll be taking a look at. And again, so much can happen between right now and when these companies have earnings. I love to open these plays literally at like as close to the bell as possible, 3:58, 3:59 p.m. if I have to, because I hate opening myself up to the risk that, I open it up the day before earnings and then it drops, right before earnings, and now I don't even have a cushion at all headed in. So I love waiting up until, right before or as close to before earnings as I can for this. So we'll, again, keep those on the watch list, but reevaluate them as time goes on. And one thing I did want to touch on briefly, we had a recurring request in our YouTube comments about, what happens when the stock market drops a ton, right? What happens with this strategy if you go a year back, maybe I've go further than a year back, you see something like this in the stock market. How does our strategy handle something like this? And while I can say we weren't publicly tracking our trades during the COVID crash, so we can't, go back to these concrete numbers and point at, hey, this is what we did, this is how we handled it. This is what, from 330 to about, 216 is roughly a 30-40% drop in the market, which, is enormous. It's pretty big, substantial. I'm sure wiped out a ton of accounts. So while we don't have trades that we publicly tracked during that period, since I think most of what we started up as far as our, public part of this was last July, what did happen to us was something even worse, right? We said this was a 30-40% drop. How about a, 60, 70, 80% drop in something that you were all in on in your portfolio? And that is exactly what happened to us with Hyliion, right? So this is what I wanted to talk through briefly, since we've had a request to go through and talk about how we handled these big losses, what we do with our strategy, and because we've recovered obviously from what happened here, and this is quite literally about as bad as it can get. So for a little bit of background info, we talk so much about diversification now. Back when I was in this trade, the account that I was trading with started the year as kind of just, a fun money trading account. And we were doing very, very well. This all happened, right? This is September, October, right around here when Hyliion peaked. And we weren't in it before this, but we were in on, I think Virgin Galactic was one that made us a really good amount of money. We were playing like call spreads on Wayfair every time it jumped. The plays that got us there, I guess, were a little bit irrelevant to this discussion. But the point is, we'd made a really good amount of money last year up into September and October. And in the back of my mind, it started the year as a play account. So this was all just kind of, just trading money that I wanted to try doing. But it grew into like a decent amount of money for me. One that, I couldn't just laugh off as a trading account. But, stupidly, admittedly, I, never really shifted that psychology for the trading behind that account. And I kept going all in on every single position, which is what I did from the start since it wasn't too much money and I was just having fun with it, but I never got out of that mindset. So long story short, we were basically all in on Hyliion right about here. And as you could see from mid to late September moving into October, the stock went from about $55 down to $20 for a 60% drop, 60+% drop. So we were basically taken for a ride as a position that we were all in on dropped, 50, 60%. So in my mind, that's a little bit worse than the COVID crash. So this is going to be a great story to illustrate the example of how we would manage something like this. And to do this, I'm going to open the previously hidden tab we had in here, our 2020 year-to-date summary, right? And I think in conjunction with that, opening the 2020 weekly tracker as well might be pretty helpful. Let me drag these to the front for ease as I tell the Hyliion story that probably a lot of you have heard at this point. So as you can see, we were just going all in on these different trades. I just kept selling space puts week after week after week because they offered really nice premiums, and we were making a lot of money. If you go here, week after week after week after week, and between July and September, right, we'd made about $37,000 just over that 7, 8, 9, 3-month period. Yeah, so really not bad at all, especially considering our account balance. So we peaked right at the back end of October with about $110,000 in the account. From there, something terrible happened in October. As you can see, we lost $47,000, which effectively wiped out our profits on the year, which is not ideal. But as you can see, spoiler alert, we made them back. We're good to go. But yeah, the catastrophic loss. So how did we handle that, right? And what I could do, I guess, walk through week by week what was going on here. These were the good times. I wish I could teleport myself. I wish I could teleport myself back to this. But we got in on Hyliion. We sold 48 strike puts, which is just like so embarrassing in hindsight, because you see us talk so much now like, oh, we hate the setup on this chart. We never want to look at something like this. I mean, we were selling 48 strike puts at the peak of this. So all this advice that we were giving in relation to entries on charts that look like that, unfortunately, is something that we, experienced live and in person and with our wallets. So right off the bat, we lost $7,000 just from that position, which is too bad because, the rest of the week, we still finished up that week. We had made a really good amount of money. But, moving forward, we were assigned the shares. We eventually had like a 40 strike basis in them because, as you can see here, the math that we did, we called this a loss up here and then called it a lower basis down here. So that's how the math worked. And then in 1 week, we had 1,600 shares at $40. And again, we mentioned that math up here. But it dropped from $40 down to below 30, which just on those shares alone lost us 16,000. We lost 1,600 with the 37 strike puts that we tried to sell to double down. And as you can see, we tried to double down a lot here with a lot of these puts. I think we were stopped out of some of these positions. That's another $5,000 loss there. So all in all, on those puts that we sold, I think roughly a $20K loss between those and the shares. And shout out to whoever just followed on Twitch for some reason. Again, the text is so small on my screen tonight, I can't even tell who it is. But whoever you are, shout out. Appreciate it. As I go through one of the worst moments in my trading life. Actually, not even one of the worst. This is unequivocally the single worst. So this week we lost $17,000, right? But again, you remember part of our H2 wheel strategy, we just keep selling calls on the way down. And while it's not gonna save us from a 20% drop in 1 week on a stock, we were still able to collect $4,700 in premium. But again, the losses far outweighed the gains on this one. We lost $17,000 that week. And he said, okay, you know what? 29.8, it can't go much lower from here. We're going to be just fine. But, little did I know, it went down to 26.8 the following week. Okay, great question from Prinsmeister in the Twitch chat about our SPX hedge. I would be happy to talk about that in just 1 second. That'll be the last thing we talk about on our stream here. So again, we thought it couldn't get worse. What we did was, stupidly, we bought even more shares, right? So we had a 2,600 share position at 29.8. It went down even more, so we lost $7,000 more there. We had some Zoom call spreads just completely blow up in our face. Lost $7,000 more there. So we lost $14,000 that week. The next week, the shares went even lower when I was telling myself at 29.8, like, okay, it can't get worse from here. It got much worse, in fact. So that's always a fun thing to remember, that if you think it can't get worse, it absolutely can get worse. We've got Dashio in the Twitch chat saying he wishes he joined us sooner. But I hope you wish you joined us after this, because if you joined us a little too soon, I think a lot of us unfortunately got caught up in this play. And honestly, I felt terrible about it because we were doing really well, started publicly tracking our trades just to, one, kind of help share them, and two, kind of prove the success that we've been having. And then unfortunately, a lot of people got dragged into the hole we dug on this one. So as you can see, again, it dropped from 22 to 18. So our stock went from $55 to $18 in the course of a month, and we were just absolutely leaking cash. If we go back to that summary, right, we lost $47,000, and honestly, that just completely boggles my mind to think about, that we just so casually lost that much money. I mean, believe me, I was not thrilled about it, but knowing what we know now, I think it's good that this happened when I had this much money, as opposed to maybe 10 or 15 years down the road if I have a lot more money. So it's sometimes the expensive lessons are the best lessons, and hopefully I could take these losses and impart these lessons upon those of you who are listening along with us, so that you guys don't have to learn them the expensive way. But anyways, we cleaned things up a little bit. We had one losing week throughout the remainder of the year, which, was fueled again by Hyliion. But, the recovery was a little bit as well. We can keep finishing this out, right? So it jumped from 18.8 up to 22. We made pretty much $9,600 back off that. We further doubled down, which was a little bit foolish, on 19.5 strike puts, but again, made good cash off that. We made some money off some Amazon credit spreads, which it looks like we were kind of in full tilt back then. It happens sometimes, but, little loss on the Hyliion shares, but premium started to dry up, so we were able to slowly recover, get $3,000 back. Hyliion jumped back to 25, able to get 7,000, 4,000 off the puts that we sold as well. So that helped us climb back a little bit. And, for how quickly we lost 47K, we got 29 of it back throughout the remainder of the year. Luckily, we still had a really big gain from before July that we were sitting on. So we still finished the year with 163% return. So, better to have that happen when you're sitting on a gain for the year than a loss. But, point being, we could take a look at, hey, how long did it take us to recover from this? So you could see at the peak before Hyliion, we had $110,000 pretty much at the beginning of October. So now we are at 132, and we didn't get back to 110 until February of this year. But, with that in mind, it took what? October, November, So our loss was in October. So it took November, December, January, and February. It took just under 4 months for us to recover from a loss where our entire account was basically in on a position that dropped over 50, 60, 70% on us when it was all said and done. So I think that little story about our path with that unfortunate investment gives a good glimpse into how we can recover from big losses or drawdowns with this strategy. And one of those things right now, emphasize diversification so much, because as we can see, look, if we have a bad week where one stock goes poorly, right? If we lose a bunch of money on RMO and STON at the same time, we've got something like UWMC picking up the slack. We've got all this to where, instead of being all in on a play that would lose us thousands of dollars, our loss is limited to $900, and then next week we bounce right back with a 16K gain, and it's like that never even happened. And I to that comment in the Twitch chat, it is so important to show the good and the bad when we invest. That's why we keep all of this super public. I mean, even this year we've made some huge mistakes, right? We have multiple weeks where we lost over 6,000. I mean, we have 1, 2, 3, 4, 5 weeks this year where we've lost over $5,000. So we definitely have not, we're not perfect, but that is so important to highlight because that's just the reality of when you trade. And when you use a strategy like this and have the high probability returns that we like to set ourselves up with, your chart is generally going to be trending up and to the right. We got a little bit riskier sometimes. We lose 15K if we, make 2 bad earnings predictions, which is what happened. And it's frustrating. We can talk about this too quickly. We lost $6,000 on Etsy and like 3,000 on Zillow, and UWMC, shit the bed the same week. So we lost $15,000 on a week when S&P 500 was up 1%. So that was so frustrating because that was such a huge setback for us. But, just like that, a few weeks later, we're right back in action. We're back at all-time highs. We haven't had a single losing month on the year. So I think this diversification that we've been preaching going forward is so important and something that we're going to look to do. And to wrap up the stream, we're going to address Prinsmeister throwing a question about our SPX hedge in the chat. So SPX right here, basically with that in mind, look, we've got about $130,000 that we're investing with. And for those of you that hear that, I don't think that should deter any of you from following this strategy. This isn't a strategy where you need $132,000 to do that. We've just been tracking, and that is the number that we are finally up to after, publicly tracking this for almost a year. But because, you don't need to sell 20 of these. You could sell 1. You don't need to buy 3,000 shares. You could buy 100 shares, and so on and so on. The important part, and we try to harp on this a little more, is this return where we're up 50% year to date, averaging 2.22% a week. Because the dollars are irrelevant. We could all target the same returns regardless of account size. But speaking of account size, because I think that's important in the context of this SPX hedge that we've been running, I try to run it with about 5 or 6% of my account as collateral, right? So we know on a $5 wide spread, if this hits max loss, we're gonna lose $4,000. So the buying power requirement on this is $4,000. That's a little under 4% of my portfolio that is dedicated to this SPX hedge if we hit a max loss. But it's a little bit smaller right now. As you can see, last week I had it at 13. I don't have any hard and fast rules about this, but I do like to keep it at that 4 or 5% range. So if this blows up in my face, I'll lose $4,000, but presumably the rest of the market's running up and we're going to hit profits on everything else that we're holding. So that's kind of the idea behind it. It's not a naked position because what it is it's a call credit spread, which is a bearish position. So, we've got the short call that we sold at 42.40, but we also have the long call we bought behind it to make it a spread to protect us. And again, we have that max loss of, $5 for the width of the spread. If we hit max profit, we're picking up $1,000. And so far, if we look back at the profits per week off these spreads that we've been running, And this does include a calculation of these more complex strangles and earnings plays as well. But we picked up $1,300 off it last week. Picked up about $1,700 off it the week before. Picked up $1,300 the week before that. $1,100 the week before that, and we really, $1,200 the week before that. We've been knocking these out of the park, honestly, since mid-April. It looks like it's been a while since we've lost money on. Yeah, we had a pretty sizable loss that week. But again, that sizable loss was $4,800, whereas since then we had made, let's see as I slowly and manually add all these up. So we lost, $6,000 that 1 week, which is not ideal. Obviously, that's not something we ever try to do. But since then, just off these hedges, we've made back $15,000. So that's how effective it is. It's kind of, I compare it so much to operating a casino in Vegas, right? You're going to have every once in a while, someone's going to come in and beat the house, and you're going to have a little bit of a setback. But in the long term, the house is always going to win. You're going to have little setbacks, but in general, you're going to see this trend in your account balance up and to the right. And that's exactly what we're going for with these high probability plays that we give ourselves with our option selling strategies. Do we have a video that explains the play in depth? Never tried SPX, but it seems pretty key to the strategy. We've got videos on credit spreads, and I think those would do the best job at explaining, what we're trying to do here. The next time I open one of these SPX spreads, I'll try to do a good job of explaining it in the Discord, why I pick the strike I pick, what we're going for here, what percent of my portfolio it is. But hopefully, that kind of thing, if you are in the Discord server, will give you a better idea of the methodology behind those plays. But, thank you for asking the question, because I'm sure, no such thing as a dumb question in here. If you're thinking something, I guarantee you're not the only person who's curious about that. Everyone on earth who's trading, and even the smartest traders on earth, started with absolutely zero knowledge. So I think that's the great thing about, learning in a community like this, is everyone started in the same place. And I think it's so great to see people's journeys as they go from, little knowledge to, implementing our strategies and seeing it work and have success for themselves. And I think that is just awesome, and one of the best parts about the community that we have formed. But with that said, I've run a little bit over time, but thank you again to anyone that has tuned in tonight. We've got a quick question, and Rochi just followed me, so I'm going to have to answer it. What's our sell to buy ratio versus options? And what we do on here for our channel, we never buy options. And I think buying options is one of the worst things you could be doing as far as an investing strategy, because an option is a decaying asset due to theta decay, due to implied volatility crush. If you're buying assets that decay over time, you're going to lose money. And that is why we use the option selling strategies that we use, because if you're buying something that decays, you're going to lose money over time. If you're selling that asset to someone and it's decaying over time, you're going to be the one who makes that money. So everything we do is an option selling strategy. But with that said, thank you guys so much for tuning in. We do this every single week. Join our Discord server if you haven't. We're a lot more active there during the trading week, which hopefully will be a good one for us coming up. Don't have too much to say other than, again, thank you so much to anyone who did tune in. And we're going to sign off the way that we always do. This has been the Hourglass Trader, where as time passes, we make money. Thank you guys, and we'll see you again next week.